Okay, students, am I audible to you all? Am I audible to you all? Okay, fine. So let's start today's session. The topic is audit risk. So if I take audit risk, I'll share this material after the session. If I take audit risk, it is confirmed 20 marks question for your final exam. If possible for section B, question number 1 or question number 2. Students, microphone. So question number 1 or question number 2, definitely this audit risk area is tested. So let's see how this can be tested in your final exam. Let's see how this can be tested in your final exam. So if I take your final examination, section A objective test question, so you should be able to perform questions related to section A as well. Especially the implication part is very much important in section A. So they will give you stories, scenarios, and how that can affect financial state. Right? What will be overstated, what will be understated, calculating materiality, right? Response to the selected risk. So those kind of things only generally tested under objective test questions. Right? But today we're going to look at section B. Section B, there are two types of questions possible, students. There are two types of questions possible under audit risk. One is they will give you a scenario. That scenario speaks about misstatements and possible misstatements within the financial statements. From that scenario, you need to identify audit risk. You need to identify audit risk. Then you need to respond to audit risk. Right? So this type of question highly examinable. So this time also 70 to 80% chance is there. This type of questions can be tested in the final exam. This type of question can be tested in the final exams. Try to understand one thing. If you take reporting questions, the impact to report, that type of question we discussed in the class. Sorry. If I take impact to audit report, those questions include confirmed misstatements only. Confirmed misstatement. Misstatement means like non-compliance with the standards. Misstatement means non-compliance with the standards. But try to understand one thing. Here, when it comes to audit risk, misstatements are possible misstatements also can be tested. Confirmed misstatements also can be tested. What is the difference between confirmed misstatement and possible misstatement? Confirmed misstatement means it's a breach of standard. Let's say research cost is capitalized as per IAS 38 intangible asset standard. So if you take IAS 38 intangible asset standard, research cost should charge to income statement. But if you capitalize, it's a confirmed misstatement. The impact is confirmed. But if you look at possible misstatement, that is something different from confirmed misstatement. What is possible misstatement? For example, revaluation. Revaluation of assets. So revaluation of assets, that's a possible misstatement. We revalued an asset. So it does not mean that we are not complying with the standard, because revaluation is allowed by standard IAS 16 property, plant and equipment. So IAS 16 property, plant and equipment standard clearly said initially asset should be recognized at cost. Subsequently, it can be recognized either cost or revalued amount. So revaluation is permitted, but whether we are doing revaluation properly or not, that is the problem. So there is a possibility the revaluation may not be correct. So that is what we call possible misstatement. So try to understand within the case study. I said, I use the word scenario here. Within that scenario, there are confirmed misstatements. There are possible misstatements. When we are writing answer for confirmed misstatement, you can use binary verbs like maximize profit. Profits overstated. Assets overstated. Liabilities overstated. Like that, you can clearly set the impact. But possible misstatement means you can't use that verb. Your verb should be changed when you are writing audit risk. You should use the word, there is a possibility assets may overstated. So the verbs you need to pick properly. So to do that, When you are writing answer, whether you are writing answer for a confirmed misstatement, whether you are writing answer for a possible misstatement, that is based on your judgment. So it's your duty to identify the scenario misstatements, either confirmed or possible misstatement. Try to understand one thing here. 90% of your case study or scenario financial statement related issues are inherent risk. 90% of the risk scenarios are inherent risk only. What is inherent risk? We discussed. Inherent risk is the risk arise in the first instance. Inherent risk is the risk arise in the first instance. So inherent risk, I told you, inherent risk is arise because of complexity in the nature of the business and complexity in the transaction of organization. Either your transaction become complex or your nature of the business is more complex. Because of that only inherent risk is possible. What is inherent risk? The risk arise in the first instance before you test related controls. Right. So when we are handling this complexity in the transaction, as I told, inherent risk is 90% examinable. Out of that inherent risk, I can say most of the case study examples are complexity in transactions. Most of the case study examples are what? Complexity in transactions only. So complexity in the transactions arise because of two reasons. Why a transaction become more complex? Why particular transaction become too complex? Simple reason. Reason number one, assertion. Reason number one, assertion. Assertion related issues. So your scenario misstatements related to cutoff problem. Your misstatement related to valuation problem. Your misstatement related to rights and obligation related problem. Your misstatement related to existence problem. So all these misstatements may be related to an assertion issue. So transaction become more complex because of what? An assertion related problem. An assertion related problem. Or a standard related problem. There are two types of problems comes under complexity in the transaction for your case study. One is assertion related issue. Cutoff, valuation, I can say rights and obligation, occurrence, completeness, presentation, classification, right? So that is an assertion related problem. Or else it's a standard related problem. It can be related to revaluation, impairment, provision, inventory, NRV, net realizable value. All these are standard related problems. So when company is not complying with a standard, or when company is not complying, or auditor is unable to verify assertion, both make transaction more complex. Both make transaction more complex. So complexity in nature and complexity in transaction, 90% of your case study students concentrate, it is complexity on the transactions only. Right. Therefore, when you are doing audit risk questions, try to understand one thing. The knowledge of assertion, the knowledge of standard is very much important to capture complexity in the transaction. Once you captured that complexity in the transaction, it's your duty to identify whether it is a confirmed misstatement or whether it is a possible misstatement. After that, you can write your answer accordingly. After that, you can write your answers accordingly. So this time also, most of you all will get this type of question, like a scenario, identify audit risk and response to audit risk. This type of question format, most probably this time also, it will be tested. But again, students, I'll tell you one more thing. The next question type is, the second type of question in section B is they will give you a scenario. They will give you a scenario and that financial statement extract. Scenario given, financial statement extract. What is financial statement extract? It can be a part of portion of balance sheet. It can be a portion of income statement. It can be a part of balance sheet. It can be a portion of income statement. It can be financial statement extract, balance sheet extract, or income statement extract. Balance sheet extract or income statement extract. So scenario will be given. Earlier question, this type of question, only scenario. Only scenario. The discussion with finance director, meeting minutes with finance director, those kind of discussions only given in this question. Section B, this type of question. Again, section B, scenario plus supporting extract will be given. a balance sheet or P&L. So when you are doing exam students, in your audit risk question, if you find out any financial statement extract, either it can be a balance sheet extract or income statement extract. If you find out a portion of balance sheet or income statement within your question, confirm you are doing ARP. What is that means? See, a scenario will be given. In that scenario, financial statement extract is also attached. So two information sources are given to you. Earlier question, only the scenario. Now two information sources. Scenario, you should apply your professional judgment. Financial statement extract, you should apply ARP, ISA 300 and ISA 520 ARP. Analytical review procedures you might study. Trend analysis, ratio analysis, reasonableness test, right? Comparing current figure with previous figure, comparing current figure with budgeted figure, comparing current figure with industry figure, right? So definitely you should perform analytical review procedures. Definitely you should perform what? Analytical review procedures. This type of question, if you get the third type of question, students, it is very comfortable to you all, but time consuming. Because they might ask you to calculate 4-5 ratios. And when you are writing audit risk, when you are identifying audit risk, you should identify from the scenario and you should identify from the ARP schedule that you are working. So both scenario and ARP together, you need to identify audit risk. After that only you need to respond to audit risk. So if you take these type of questions only possible in the exams. Therefore, students, those who want to prepare for the exams at the last moment, it's your duty to identify what type of questions possible. Practice question type 1 as much as you can. And prepare a case study list. It's very, very, very important. Because all these issues are repeatedly tested. Then again, practice questions, scenario and extract. Perform ARP. Then identify risk and response to risk. Right. So please practice both type of questions. If you get a question, scenario, identify audit risk and response to audit risk, the cases are a bit complicated. You should have a very sharp knowledge in standard. And those who are practicing last 10 years past paper, it is more than enough to pass this question very easy. Right? Because the same stories are repeatedly tested. But if you get the third type of question where you need to perform ARP, cases are very simplified format because there is a logical connection. Right? For example, if your receivable days are increasing, credit risk, both can be combined. That logical connection you should understand. If the inventory days are increasing, NRV issue, both can be connected. So when inventory days are increasing, there is a high chance entity unable to sell their inventory, finished good in the market, which means there is a possibility the net realizable value might lesser than cost. So those type of relationship you should know, then it is very easy to merge both and write your answers. Now let's look at how to write audit risk answers. So risk answers, the table will be automatically generated. One side it is risk and the other side it is response. Response means don't think too much. It is procedures only. If you take procedures in the audit, we are doing at 3 different stages. Procedures we do at 3 different stages. So let's see how to write answer. The procedures, as I said, there are 3 stages in the external audit where we apply procedures. Planning stage, we perform procedures. For example, risk assessment. Risk assessment, we should perform certain procedures. Analytical review procedures, that is also comes under planning stage. All those are procedures comes under the planning stage. Planning stage procedures. Conflict of interest, ethics, you might study how to reduce the risk of conflict of interest. For that, there are certain procedures are given. That is planning procedures, right? Interim audit, planning procedures. All those procedures we performed, we call planning stage procedures. Performance stage also, we perform certain procedures. That procedures we call substantive procedures. So substantive procedures we divided into 2. One is substantive analytical procedures, test of detail. And performance stage, we perform test of control. Test of control is also procedures. Test of control is also procedures, right? How to reduce, how to test controls. That is also procedure. Therefore, students, here the procedures are planning procedures. What I should do to reduce the risk. What I should do to reduce the risk to acceptable level. That is what we call procedure here. And when we are writing answers, students, there are 2 types of answer structure. One is for inherent risk, either standard or assertion. Standard or assertion. First, what you should mention? You should identify the issue. Then you should mention the standard, or else you should mention the assertion. If it is a cutoff problem, mention it is a cutoff problem. If it is a valuation problem, mention it is a valuation problem. So identify the issue and also mention the standard or the assertion. Then impact to financial statement. Most of the students, they are not writing implication to financial statement. When you are writing implication, try to balance both balance sheet and income statement. Impact to balance sheet, assets, liabilities, profit. Impact to income statement, profit. So try to write implication in a proper. That is, we call what risk? Inherent risk. So inherent risk, these 3 points to be satisfied. Other than inherent risk, we need to identify the key issue. Then we can't write standard. For example, a control risk, you can't write standard. A detection risk, you can't write standard. Inherent risk, complexity in the nature, you can't write standard. For example, particular client is our first auditor. Now only we accept that audit. The risk is very high. What is that risk? Nature complexity. Complexity in the nature. That will increase inherent risk of nature, that increase the detection risk because we are not familiar with the concepts and the process. So those type of issues, we should identify the issue and we should write the impact. We should identify the issue and we should write the impact. So this is the general idea about audit risk. This is the general idea about audit risk. And you should know how to approach audit risk question. So always I'm telling to students, take the case study list, make a case study table. Make a case study table, right? That case study table helps you make a case study table. That case study table helps you to identify the problem, right? Because those problems are repeatedly tested. So 1 minute, I'll show you. One minute, I'll show you case studies. See here, if you take this PDF document, see here, audit risk and response. These are the case study lines. These case study lines will be repeatedly tested. Repeatedly tested. So if you prepare a schedule, a case study lines like this, and if you know what is audit risk and what is the response, even though you are not working, a full-time student, you can easily pass. You can easily pass, right? So try to prepare a case study lines like this, right? And identify the audit risk and response to audit risk. That is very comfortable. That very comfortable and very easy to approach this question. This is how you should approach past paper question. If you want to pass this paper, the risk paper is like a predetermined paper where the case study lines are repeatedly tested. So if you familiarize yourself with these case study examples, if you familiarize yourself with these case study lines, to be very comfortable to write answers. When you are reading a case study in your final exam, no need to think because already we practice. Immediately we can write answers. Immediately we can write answers without a doubt. Without a doubt. Okay. Now, students, what we discussed up to now, understood, yes or no? What we discussed up to now, understood? Now, students, let's start with a case study. Now, let's start with a case study. See here, first we'll take this question as it is. First, we'll take this question as it is. The case study is given. I couldn't find any because I break this question into different portions, right? To explain to you all in an easy way, simplified way. They gave a case study and they asked, describe 6 audit risk and response. So this is type 2. Case study is given. They ask us to identify audit risk and response to audit risk. The same time, if I take the next question, I gave the answers here. The next question, if I take, see, they gave financial statement extract. So when they gave financial statement extract, definitely question number 1 is ARP. See here, calculate 5 ratios. Then from the information provided scenario and the ratios calculated ARP, identify audit risk and response to audit risk. So here students, there are certain relationship we should understand. Okay. So now let's move to the question. Now let's move to the question. So I'll take this question. Before that, students, right, in your exercise book, right, put a subheading, right, how to write audit risk answer and copy this table because you should know how to approach audit risk answers. You should know how to approach audit risk answers. Please write this. Sri Lankan students, please write this. Right. So Indian students, already you have these things, right? So Sri Lankan students, you copy this table first. Then I'll move to the question. Sorry, there is a small internet issue. 1 minute. Ijaz, can you make me host? Okay. Now, students, let's take this case study. Now, students, let's take this case study. See here, question number 1. Keep one thing in your mind. As I said, 90% of your problems are inherent risk. See, you are an audit supervisor of C and company and are planning the audit of your client. Client name is CTR, which manufactures cleaning products. The company is manufacturing what? Cleaning products. Its year end was 31st July 2006. Always year end is important. I'll tell you the reason. One is cutoff problems. If you know year end, then we can able to identify cutoff issues. Number 2, IAS 10 events after reporting period. When we know year end, it's able to identify adjusting event and non-adjusting event. Right? And the draft profit before tax is 33.6 million. Why they gave that? To calculate materiality. So when we need, we can assess materiality. Because materiality threshold ISA 320, you all know, profitability, net assets, revenue, all these things are given. You are supervising large team for the first time, and you are supervising a large team for the first time, and will have specific responsibility for supervising, reviewing the work of audit assistants in your team. See here, I told you complexity in the nature and detection risk. When we have competency issue, when we have competency problem, when we have lack of competency, it's very difficult to detect misstatements. Fine. Let's say when I am teaching audit, the level of understanding. If I ask some other lecturers, let's say a tax lecturer, I'm asking tax lecturer to teach audit. He can teach tax well, but if I ask him to teach audit, the competency level of both lecturers are different. The level of understanding is different. So what I'm trying to tell you is when we supervise a large audit team first time, competency issue. Competency will affect the quality. ISA 220 is quality, individual quality control, firm level quality control. ISA 220, individual quality control and firm level quality control. Therefore, it's a quality problem. Detection risk. How to write that answer? Let's take answer scheme. Let's take answer scheme. So second point here, see the case study scenario. CTR purchases most of its raw material from suppliers in Africa. So Africa is a country located far away from this territory. New range of cleaning products, and shipped directly to the company's warehouse. So the raw materials are supplying from Africa, and these goods are shipped directly to company's warehouse. But it will take a transit of 3 weeks. Shipment, logistic, transit up to 3 weeks. When there is a transit up to 3 weeks, students, cutoff problem is there. That's why I told you. When is the year end? Year end is 31st July. Let's say if I put an order by 25th of July. If I put an order of 25th of July, it will take 3 weeks to reach that goods to my stores. So, at which point I should recognize liability? Purchase. Purchase is an obligation, liability. So, at which point? When I place the order, I should recognize purchase. When I receive good, I should recognize purchase. This is a cutoff problem. So some people, some accountants, what they do is at the time of you are sending the order, you recognize it as a purchase. You can't do that because obligation should be satisfied. At the time, goods dispatched by the supplier. At the time, goods dispatched by the supplier, that point, yes, you can recognize the purchase. So this will create a cutoff issue. There is a possibility some purchases belongs to next year, recognized now. Some purchases belongs to next year, may recognize now. Sometime current year purchase may recognize later. So that will create a cutoff problem. It's an assertion issue. It's an assertion issue. Cutoff is an assertion. Income statement assertion. Now let's take the story. Here see. S company purchased their goods from suppliers in Africa. Goods are transit up to 3 weeks. This is the key issue. Second one is assertion. At year end, there is a risk that cutoff of inventory purchase payable may not be accurate. That is the problem, assertion problem. What is the impact? Your inventory, which means your purchase and your payables. Payable is a balance sheet element. Purchase is an income statement element. May be overstated. Possible. There is a possibility. It may be understated. There is a possibility. It may be overstated. So it's a cutoff problem. So all the cutoff issues, what we should do is we should perform a cutoff test. What is cutoff test? What is cutoff test? Simply we should take the GRN, good receive note. Once we accept the goods, we should send GRN to the supplier. That is the point where we are accepting the goods. That is the point where liability is created. So you should select the GRN before the year end and after the year end. That sample we call block sampling method. Last 5 GRN of current year, next 5 GRN, first 5 GRN of the next year. And ensure whether that GRN is recorded in the correct accounting period. Whether that GRN is recorded in the correct accounting period. Okay. That is we call the response. So here it's a cutoff issue and the response is cutoff test. That is the way of writing answer. So this is an assertion related problem. This is an assertion related problem. Now students, the company has incurred 1.3 million expenditure on developing a range of cleaning products which are due to be launched into the marketplace November 2006. So how much expenditure? 1.3 million of expenditure. When there is an expenditure, students, in your exam case studies, when they speaks about expenditure, IAS 16 speaks about 2 types of expenditures. One is revenue expenditure, 2 is capital expenditure. One is revenue expenditure, 2 is capital expenditure. What is revenue expenditure? Revenue expenditure as per IAS 16, revenue expenditure is an expenditure where earning capacity is maintained. Capital expenditure is an expenditure where earning capacity is expanded. If you want to expand earning capacity, for that if you spend, that spending we call capital expenditure. If you try to maintain earning capacity, for that if you spend, that spending we call revenue expenditure. Revenue expenditure goes to income statement. Capital expenditure goes to balance sheet. Capital expenditure goes to balance sheet. Here 1.3 million expenditure to develop new range of cleaning products. So that 1.3 million might include some capital expenditure. 1.3 million might include some revenue expenditure. It does not mean that entire 1.3 million should goes to balance sheet. If client is said, yes, we develop a new product and that is a development cost and it is generating income, additional income is generated, you can't satisfy. Don't satisfy with the explanation given by client. Verify. How to verify? I should take the breakdown of this 1.3 million. I should ask from the client, give me the breakdown of 1.3 million. How the 1.3 million total arrives? By looking at the sub points of 1.3 million, the breakdown of 1.3 million, see the nature. Look at the nature and try to identify whether it is a capital expenditure or revenue expenditure by looking at the nature. If it is a revenue expenditure, charged to income statement. If it is a capital expenditure, charged to balance sheet. Therefore, this is kind of a classification problem. This is kind of a classification problem, or else you can take it as IAS 16 problem. Both are correct. Some students might take this as IAS 16 perspective. Correct. Some students might take this as a classification issue. Correct. Because classification is an assertion which comes under balance sheet and P&L both. Income statement assertion, classification. Balance sheet assertion, classification. Therefore, this is a classification problem. This is a classification problem. Is it clear, students? What I said, understood? Yes or no? First, we discussed cutoff issue. Second thing, we discussed classification problem. Revenue, capital expenditure. Is it clear? Now, let's take this. Now, let's take this. Let's look at the answer. Now, let's look at the answer. When I'm giving my answer, I will give as per the points, right? But when you are looking at suggested solution, same points covered, but everything is mixed together. Okay. See here, students. S company incurred expenditure 1.3 million in developing new range of cleaning products. They didn't give that classification here. They didn't give that classification here, but they took as a separate intangible asset. So let's continue. Let's continue with the case study. You can take that as well, right? Because 1.3 million expenditure to develop new product, but try to understand this development cost. This development cost is an intangible asset. So you can take this 1.3 million as a classification problem of expenditure. And also you can take this as what? IAS 38. See here, normally according to IAS 38, research cost should charge to income statement. Development cost, if the conditions are satisfied. Development cost, if the conditions are satisfied. What are the conditions? The conditions are given in the case study. The conditions are given. What are the conditions? There should be an active market. You have resources to complete that particular development cost. You can able to use or sell, right? So there should be an active market for that product. All these things are the conditions. If those conditions are satisfied, only development cost can be recognized as intangible asset. But here, if you look at, they said 1.3 million of expenditure of developing new range of cleaning products, which are due to be launched into the marketplace in November. So there is a development. They're going to launch that in November. In September, company invested 0.9 million complex piece of plant and machinery as a part of development process. The full amount is capitalized. The full amount is capitalized. So first problem is 1.3 million research cost, development cost, classification. Sometimes the development cost, they said 1.3 million expenditure as a development cost. They might recognize it in the balance sheet. But sometimes 1.3 million might include some research cost also. The classification. But the second thing they said, it's clear, it's a confirmed misstatement. This is a confirmed misstatement. Look at the story here. In September 2005, S company also invested 0.9 million. 0.9 million is invested in a complex piece of plant and machinery. 0.9 million is invested in a complex piece of plant and machinery as a part of development process. As a part of development process, they invest 0.9 million in a plant and equipment, machinery. The full amount of 0.9 million is capitalized. The entire 0.9 million is capitalized. How to capitalize PPE? Cost, property, plant and equipment, debit, cash, credit. So 0.9 million is capitalized as cost. But IAS 16 property, plant and equipment standard clearly said what is cost. IAS 16 property, plant and equipment clearly said what is cost. What is cost? Purchase price of the asset and any cost incurred to bring the asset to present condition and make it workable condition, and expected value of dismantling cost, present value of dismantling cost. These are the three components of cost. These are the three components of the cost. But try to understand Here they said the cost of 0.9 million include purchase price. Correct. Installation cost. Correct. Training cost. Training cost is a revenue expenditure. Training cost is a revenue expenditure. Standard do not permit to include training cost. Training cost is a recurring cost. It's a revenue expenditure that should goes to income statement as an expense. You can't put that as asset cost. By that, what happened to your property, plant and equipment cost? Cost is overstated. 0.9 million is capitalized. By that, your cost is overstated. Cost of the asset is overstated. If the cost of the asset is overstated, what is the another impact? Depreciation is incorrect. Because depreciation, there are few methods. What is the method? Cost method, straight line basis. Cost minus accumulated depreciation divided by expected useful life. When we include training cost, my cost is overstated. If my cost is overstated, definitely my depreciation value also misstated. Depreciation value also misstated. Therefore, you can take this problem, this 0.9 million as a overstatement of cost. IAS 16. Another audit risk you can identify, incorrect depreciation. Both you can take it here. So two audit risks you can discuss here. Two audit risks you can discuss here. Is my explanation understood, students? Is it clear? The first problem is cutoff. The first problem is cutoff. Cutoff comes under inherent risk. Cutoff comes under inherent risk. The second problem, 1.3 million classification, revenue capital or research cost or development cost. Still it is a classification. IAS 38, standard complication. Again, that is comes under inherent risk. Third one, IAS 16, property, plant and equipment, 0.9 million. Cost is overstated. Incorrect depreciation. Both are inherent risk. See, so far what we discussed in the case study, everything is inherent risk. Everything is inherent risk. Now let's move to the story. This year, the bonus scheme for senior management and directors has been changed so that rather than focusing on profit, it is based on the value of year-end total assets. So bonus is based on year-end total assets. What happened here? See, cost is overstated. Cost is overstated. Reason? If you overstate cost, asset overstated. Why they should overstate asset? Because bonus is based on asset. See the rationale. See the rationale. And 1.3 million they recognize as a development cost. Development cost is capitalized. Asset overstated. Why they are trying to do that? Because of the bonus. So that shows there is a manipulation within the financial statement. There is a risk of manipulation. When the bonus is based on profit, when the bonus is based on total assets, there is a risk of manipulation. Manipulation is fraud. ISA 240 standard. You might study this under planning topic. What is fraud? Two things are defined by fraud. ISA 240 defines fraud as two things. No. You can't say like that. Devaki, that is wrong. Because the problem is here, whether it is a research cost or development cost. Whether it's a research cost or development cost. Fine. And I'll tell you why. See, cutoff is an income statement element. Here, Devaki, what you are mentioning is a balance sheet asset. So you can't recognize next year to current year to next year. Cutoff is an income statement problem. Cutoff is an assertion of income statement. If you are talking about income statement element, you can talk about cutoff. Here you can't because it is an asset. Is it clear? Why I am telling that is wrong? Understood. Is it clear there? See here, you are telling like they are trying to recognize assets to current year instead of recognizing next year. You are talking about a cutoff problem. Am I right? You are talking here about cutoff problem. But try to understand, cutoff is an assertion that we are going to test to income statements. Income statement element. Balance sheet, we are not testing cutoff. Yes or no? Balance sheet item. Asset is a balance sheet item. Then by my question, why you are testing assertion cutoff into an asset? You can test this particular cutoff into an income statement element. Is it clear? Yes. Now, students, let's take here ISA 240, the standard defined the term called fraud. What is fraud? Fraud is include two things. One is misappropriation of assets. Two is manipulation of financial statement. One is misappropriation of asset. Two is manipulation of financial statement. Here, the second type, manipulation of financial statement. It's a risk of fraud. It's a risk of fraud. I'm telling the risk of fraud here, it's a control risk. Why I'm telling a risk of fraud is a control risk? Simple reason, you might study this under ISA 240 fraud. Primary responsibility is with management. How management achieve their responsibility? By developing internal controls. When a company is having sound controls, effective control, there is a less risk of fraud. When companies have a culture and controls are there, so as to meet management responsibility. So management implement a culture, management implement a control. Through that, management is trying to remove fraud from the entity. Sometimes you might have a doubt how culture works. Simple, culture is a very strong control, organization behavior, organization structure, reporting channels. And also always culture is too strong. Go and ask from a Hindu friend, will you eat beef? That person will say no. Go to a Muslim friend and ask whether you eat pork. That person will say no. Those are prohibited by culture. That is too strong. If something is wrong, if it is defined by the culture, it is too strong. Organization behavior is also same. If organization behavior said it is wrong on. That's how management try to remove fraud. Fraud is wrong by the culture. Fraud cannot be possible by the controls. So here they are talking about manipulation. It's a control risk. Why they can able to overstate asset? Because the controls are not effective. That's why it is possible. That's why I'm telling this is a control risk. That's why I'm telling this is a control risk. Is it clear, students? Is this example, this case study line understood? Bonus. Is it clear? Students understood? Right. Now, students, concentrate. In previous years, an allowance for receivable made up specific balances. Allowance for receivable. Students, give me 1 minute. Okay, students, let's take a small break. Okay. After that, let's continue. Right? Now time is 7 o'clock. Right? So I'll start at 7:10. Take a small break. Then let's continue this. Okay, take a break. Okay, let's start here. See, in previous years, allowance for receivable is a provision. Bad debt and doubtful debt. Doubtful debt is an obligation that arises in the future because of the sale that we made in the past. So present obligation arises as a result of past event. IAS 37 provision. Allowance for receivable is a provision that you should understand. Depreciation is also provision. Made up specific balances which equal almost 1% of the trade receivable was maintained. Right? So 1% of trade receivable they maintain as allowance for receivable. However, the finance director feel this is excessive and unnecessary and therefore not included in for 2006. So already they are maintaining 1% of trade receivable allowance. But now finance director is feeling this is excessive and no need, unnecessary. Right. Therefore, he has credited opening balance to profit and loss account. See, how finance director feel it is excessive? That is my question. Professional judgment and professional skepticism. You can't simply say, I don't feel it is excessive. I feel it is excessive. Those are not rationalized answers that we expect from a client. If they said it is excessive, they should prove. How? Show me the evidence. They stop credit sales. Then no need to make a provision. Only cash sales. Then I'm agreeing. Without telling that rationale, if they just said it is excessive, that is fake. That is fake. I have a judgment now. Shall I tell you what? Allowance for receivable is a provision. Double entry for provision is expense account debit, provision liability account credit. Instead of crediting liability account, what we do is we reduce it from receivable balance. That is reduced from receivable balance. That's a liability. Now what happened? They are not maintaining allowance for receivable. By that, what will happen? Their receivable balance is overstated. Receivable balance is an asset. Asset overstated. Why they are trying to overstate asset? Because bonus is based on total assets. Is my explanation understood? So it's an IAS 37 provision related issue. Provision is not complete. The provision is not complete. So assertion is completeness. So two things. One is assertion is completeness. Two is IAS 37. You got my point? Exactly, it's an understatement of provision. By that, what will happen? Overstate the assets. You got my point? Students, what I explained here understood. Try to understand one thing. See the logic here. Students. When you are complying with the standard, automatically assertion is also satisfied. When you are not complying with the standard, that will create an assertion risk. Here you are not complying is IAS 37. By that, completeness risk is arise. That's why I'm telling you can argue with the view of assertion. You can argue with the view of standard also. No problem at all. Next one, see here. A new general ledger system was introduced in May 2006. Where the year end is July. Closer to the year end. The finance director has stated that the data was transferred and the old new system were run parallel until end of August. As a result of additional workload. So when you are maintaining and when you are developing a new system, there is a risk of transfer of data. From one system to another system, you need to transfer data because you are running parallelly. When you are transferring the data from one system to another system, there is a risk of errors because it is not a simple thing. When you are transferring from one system to another system, there should be sufficient controls. There should be sufficient procedures. There is a systematic way to transfer. Otherwise, that will result errors. So it's a control risk. It's a control risk. Not only that, they said here, see, as a result of the additional workload, so that parallelly running two systems will create additional work pressure. So that additional workload of the finance team, a number of control account reconciliations were not completed. That is also a control risk. See, control account reconciliation, bank reconciliation statements, and also supplier confirmation reconciliation. All these are financial controls. Trial balance is a financial control. Fixed asset register is a financial control. So when we are not maintaining a fixed asset register, when we are not maintaining bank reconciliation statement, when we are not maintaining control account reconciliation statement, then control account reconciliation includes some unreconciled item. Bank reconciliation statement includes some unreconciled item. All these things are creating a control risk. When controls are not effective, risk of material misstatement is very high. Risk of material misstatement is very high. Therefore, it's a control risk. So these two are control risk only. These two are control risk. Therefore, we can't explain standards. The issue should be explained and the impact should be explained. Right? And also here, see, the finance director is comfortable with this as these reconciliations were completed successfully June and August. No, for entire year, you should do that. In addition, the year-end close down purchase ledger was undertaken 8th of August. When is the year-end? When is the year-end? Year-end is, concentrate, year-end is 31st July. When they close the ledger? 8th of August. Cut-off risk. 8th of August means cut-off risk. After the year-end, cut-off risk. So that is a cut-off problem. So explanations understood, students? So if you look at this case study, majority is what? If you look at this case study, majority is what? Simple. It's an inherent risk. Therefore, try to familiarize with the scenarios. What I explained to you all understood? Yes or no? Students understood? So students, again, I'm moving to examinable questions which I gave to you. Misstatement, possible misstatement. See, misstatements also given. What is misstatement? In our scenario, I'm taking the scenario to explain this now again. Our scenario, cost include training cost, PPE. Misstatement is confirmed misstatement. Right. And also possible misstatements. There are a lot of examples given here. Possible misstatements. One is cut-off issue. It will take 3 weeks time. It is not a confirmed misstatement. There is a possible mistake. Okay. Now let's take the third story. Where the scenario is given. Financial statement extract is given. We should perform analytical review procedures. And then we should identify audit risk and response to audit risk. That type of question we can start here. How to identify that type of question? Make it very simple. Within your audit risk question, if you find out any financial statement extract, that is an ARP question. Don't forget to calculate ratios. I'll tell you the number of ratios. Some past papers, they might ask 5 ratios. Some past papers, they might ask 3 ratios. Some papers, they might ask 2 ratios. But try to compute these type of ratios. First one is profitability. Under profitability, calculate gross profit and operational profit margin. Liquidity ratio. Under liquidity ratio, current and quick ratio. Efficiency ratio, don't forget to compute all 3 ratios. It is mandatory. Most of the audit risk we picked from efficiency ratios only. If I take efficiency ratios include receivable days, payable days, and inventory days. Mandatory. You can ignore profitability ratio. You can ignore liquidity ratio. Don't ignore efficiency ratio because efficiency ratio teaches a lot of things. Then finally, debt ratios, if you wish, take it, otherwise leave it. Right. Now the logic I am going to explain. Sometime in your exam, examiner might ask you to calculate only 2 ratios. Don't bother. Calculate all. Especially efficiency ratio. Sairam. Yes, I got your text. Sairam, I got your text. Give me about Only one day. Okay. I'll explain all those things again. Right? Give me one day. Tomorrow, probably I can able to explain. Time. You all know that I don't know whether you are aware about this, right? Sister's wedding, right, tomorrow. So that's why I'm very busy these days. After tomorrow, Thursday, I can able to clarify some of your doubts. I know there is small backlog, Indian students, right? They are sending some doubts. I am not in a position to respond due to hectic schedule. Okay. But all of your doubts will be rectified by Friday or else tomorrow onwards. Okay. Is it clear? Fine. Even some Sri Lankan students also, you put some doubts in TRG group. I didn't respond. Right. All of your doubts, I will clear, right, from tomorrow onwards. Right. Okay, fine. See here, students, profitability and liquidity ratios indicate going concern problem. What is the issue denoted by these two ratios? Going concern problem. So when you find out the liquidity ratios are not performing well, profitability ratios are not performing well, what is the indication? It's a going concern indication. That understanding you should have. Efficiency ratios, when we are calculating, there are three types of efficiency ratio. One is receivable days. Two is payable days. Three is inventory days. Receivable days, students, it related to credit risk. I'll tell you, when receivable days are increasing, you unable to receive money from customers. It's delaying. That shows credit risk. Payable days means when payable days are significantly increasing, that is also an indicator of going concern. You might study going concern ISA 570 under completion and review topic. Under completion and review topic before reporting. So under that you might study going concern indicators. When payable days are increasing, it's an indicator of going concern. Next one is inventory days. If you take inventory days, that is an indicator of NRV issue. Net realizable value lesser than cost. So this relationship you should understand. Again, debt ratios, that is also going concern. That is also going concern. So this relationship you should know. For example, in this case study line, okay, those who attend session, Sri Lankan students, copy this relationship first. Did you got this relationship from your class? For ARP, did you got these relationships? Please write down this relationship first. Because if you should know this relationship, then it is easy to do this question. It is very easy to do this question if you know the relationship. Copy this relationship first. Yeah, I will share this document, but try just copy because then you can easily understand. To improve your understanding, definitely I'll share this material. And also, I will share auditors case studies also. I will share auditors case studies also. Now, students, concentrate. Now, let's take the story. Here, see, you are the audit senior of Rhino and Company planning your audit of Kangaroo Construction for the year ended 31st March 2013. 31st March 2013 is the year end. Why you should understand about the year end? Because cutoff issue arise. We can identify cutoff issue. So cutoff issue is a matter. Cutoff issue is a matter here. Kangaroo specializes in building houses and provide 5-year building warranty to its customers. Giving a warranty to customer repeatedly tested in case studies. Giving warranty to customers create a present obligation arise from past event. What is a past event? Past events I made a sale. Present obligation warranty claim. 5-year from the date of sales, next 5 year this obligation is arise. That is comes under IAS 37 provision. So that is one problem here. Okay, mark it. First problem is IAS 37 provision related issue. If the provision is not created, provision understated, profit overstated. Second one, the Kangaroo had a difficult year. House prices have fallen. It's a construction company, student. For a construction company, completed house is not an asset, fixed asset. It is a inventory. Generally, motor vehicle is a non-current asset. But if you take a motor vehicle for a, like you can say a motor vehicle or any vehicles in a like I can say, for example, in a showroom, in a vehicle showroom, it's an inventory. So this company is constructing houses. So construction company, completed houses, apartments and all, it's an inventory. So what is happening here? The kangaroo has had a difficulty here, they said, and houses prices have fallen as a result of revenue drop. In order to address this, management offered significant extended credit terms. So there is a credit risk. Here they are explaining the credit risk. They are extending credit terms to customers, installment scheme and credit terms. There is a significant increase in the credit risk. It is supported with our computation of ratio. See here, what happened to receivable days? Earlier, 49 days, now 91 days. So when my receivable days are increasing, credit risk. So that is proved through the working of ARP. And also it is proved through the story. Now I put both together in my answer. See here. Receivable days are increased from 49 to 91 days. This is from my ARP. And management has significantly extended credit terms. This is from the story. Both should be merged together. That is the only difficult thing. To do this, you should know the relationship. When receivable days are increasing, credit risk. When payable days are increasing, going concern. When inventory days are increasing, NRV. You should merge both together. This leads to increase of recoverability of receivables where receivable is overstated. Students understood how to connect this. One relationship I told you, credit risk. Receivable days calculated, credit risk term is given in the story. I merge both together and I write down the answer. Is it clear? Now understood how to write ARP answers? Now understood how to write ARP answers. When you are taking the issue, students, take it from the ARP. Take it from the story. Merge together and write down. Some issues only story. Some issues only ARP. That is fine. But if there is a connectivity, you should merge both together. What are the areas going to be connected? Going concern and profitability. Going concern and liquidity. Credit risk and receivable days. Going concern and payable days. NRV issue and inventory days. Debt and going concern. This relationship you should know to merge. Again, students, let's take this. Again, students, let's take this. However, the demand fallen. There are still some completed houses. Completed houses is inventory. Still in the inventory where the selling price may be below cost. They said selling price may be below cost, which means there is a risk of NRV. Net realizable value. Net realizable value may lesser than cost. Net realizable value may lesser than cost. It's an NRV issue given in the story. Now let's look at the ratio. Now let's look at the ratio. Take the ratios. Inventory days. 2012 it is 64 days. 2013 it is 99 days. Inventory days significantly increased. By that they are telling in the story NRV issue. Both should be merged together. See here. Due to fall in demand for kangaroo construction houses, there are some houses where selling price may be below cost. IAS 2 standard require inventory should be stated lower of cost or NRV. Standard issue. In addition, inventory days increase from 64 to 99 days. I am telling inventory days also. By that, there is a risk of overvaluation of inventory. Now, students understood how to connect. How to connect? Is it clear? Students understood how to connect. ARP question, you got a point? You all got a point about ARP, how to do a risk question related to ARP and story. So try to understand, students. One is identify risk and respond to risk. Two is identify risk based on the ARP and then response to risk. Okay. So students, I'll share this material to you all. Just go through and this is how auditors can be tested in your exam. Okay. Today I'll stop little early. Right. Next week I'll do 3 hours. Right. I'll do TRG through and TR3 and TRG4 together. Okay. Because I do not want to cancel today's class and I don't have time to do it also later. So let's finish it off a little early today. And I'll share all these materials with you all. Indian students, no worries. You all have all these materials with you. Right. And with that point, I'll stop for the day. Do you have any questions? From tomorrow onwards, you can raise all your questions. Right. I'm ready to respond, right? So what we discussed is productive today, audit risk. What we discussed today, audit risk, is it productive? And whatever the questions related to audit risk, we can discuss. Whatever the questions related to audit risk, we can discuss. Okay, with that point, I'll stop for the day. Right. Okay. Thank you very much and good night.